That short-term rental that you bought a few years ago might have been a great deal when you closed on it, but here's the real question. Is it still a good investment today? See, most investors only look at cash-on-cash return, how much they're making based on what they originally invested. But the real power move is understanding your return on equity, how much your property is returning now based on what it's currently worth. And in this video, I'm going to walk you through the exact math to figure out whether it's time to hold or time to sell, how return on equity plays into your next move, and how to avoid losing momentum if you decide to exit. Let's get into it. First things first, we have to talk about cash on cash return. Now, this is the metric that most short-term rental investors use to see whether or not the property is a good deal or not. Cash on cash is very simple. You're going to take the amount of money that you invest into the property. Let's say I bought a $500,000 property. I put $100,000 down, and that property is going to net me $20,000 a year, right? So $100,000 down on a $500,000 property. I'm going to take out a $400,000 loan, and that property is going to net $20,000 a year. That is a 20% cash on cash return, which basically means that I will have made the money that I invested into that property back in 5 years. And that's what we're looking for. We are ideally looking for cash on cash to be at 8 years or less. Why 8 years? Well, that's the bare minimum that the stock market returns, right? If I do 100 divided by 8, and that comes out to be about 12.5%, that's the stock market's 8% plus your time and effort to go manage that property, right? So you can't just return what the stock market returns, because then you would be keeping in line with the stock market. When we buy real estate, we want the cash on cash, we want the appreciation, we want the tax benefits, we want the loan pay down, and we don't just want cash on cash return. So this is a great property, and this might have been you 2 years ago. But let's say the same property now, when we look at the ROE, we have to figure out how much equity is in the property. Because this $500,000 property 2 years ago is now worth $700,000. Okay, so the property is worth $700,000, and let's say that your outstanding loan balance, you took out a $400,000 loan, you paid some of it down over 2 years. Let's say your outstanding loan balance is $380,000. So the equity in this property is $320,000. That's how much equity you have in the property. But here's the kicker. You are not going to make more cash flow. Why? Well, once you achieve efficiencies in a short-term rental market, you can cut costs as much as possible, but there's some fixed costs that are always going to remain the same, if not increase. I'm talking about property taxes, insurance. Try to get insurance right now in Florida. It's basically impossible, right? All these costs. And so if you're still netting the same $20,000 a year, you got to ask yourself, how many years would it take me renting out this property in order to make back what I could sell it for? Well, in this example, $20,000 goes into $320,000 16 times. Okay. What does that mean? I would have to manage that property. I would have to deal with the tenants. I would have to deal with the guests, the headaches, the property managers, the cleaners. I would have to deal with that for 16 years just to make back what I could sell the property for today and redeploy it into another asset, right? Because remember, the cash on cash deal that you got at a 5-year return is great. What if you can multiply that by 3? Okay. Let's take this $320,000 in equity and let's do the same thing over again, right? So I'll take $100,000. I'll go buy another $500,000 property. I'll take another $100,000. I'll go buy another $500,000 property. I'll take another $100,000 and I'll go buy another $500,000 property. And over this time, and by doing this, look what I have in fair market value. I went from having only $700,000 in fair market value to $1.5 million in fair market value. I doubled my asset value by doing this. And every year, the appreciation is going to compound on each other, right? So it's going to be worth more money every single year because you did this smart move, right? So each one of these properties, again, is going to have a 5-year return, right? So this property is going to net $20,000. This property is going to net $20,000. And this property is going to net $20,000. And at the end of the day, you are going to have 3 times the cash flow because now you're making $60,000 instead of $20,000 versus $20,000. And your asset value is going to be $1.5 mil versus $700,000, and your tax benefits are going to be on $1.5 million versus $700,000. So you see, you can't just hold on to properties forever. I used to have that mentality. I've had mentors, I've had people tell me, real estate's for buying, not for selling, never sell. But when you are trying to build your portfolio, you're trying to get out of your job, you want to spend more time with your family, you have to be doing your return on equity analysis every single year to determine whether or not you should keep the property or you should sell it. And remember, going back to that break even, I personally recommend a break even of no more than 8 years. If you're looking at this math and your property and you could break even within 8 years, you keep the property. If it's more than 8 years, now we have to talk about selling the property and redeploying that capital into another asset. By the way, if you're looking to make sure your portfolio is working for you as hard as it should, that's exactly what my team and I do. We work one-on-one with real estate investors, not only helping them build a tax strategy to save $10,000 to $50,000 on taxes, but also helping them understand numbers like we're talking about in this video. We'll build you out an exit strategy or an acquisition strategy and hold your hand for the next 12 months as you scale your portfolio. If that's interesting to you, click the first link in the description and there's more info on the next page. There's two main types of investors that we deal with all the time. There is either the investor that is focused on cash flow, or there's an investor that's focused on the appreciation and the tax play. And let me explain why. So a lot of markets for short-term rentals are going to have one or the other. They're never going to have a lot of all three. So right now, a lot of properties that are cash flowing are typically in lower cost states like the Midwest, even Southern Florida. Like some of those properties are going to cash flow, right? But those same properties like in the Midwest, Illinois, where I live, you're not going to see the same appreciation. You're also not going to see the same tax benefits. So it's normally one or the other. You have to pick which one suits you better. Because remember, if you're working a W-2 job and your goal is to get out of it, you need to focus purely on cash flow. Don't worry about the appreciation. Don't worry about the tax play. Focus on replacing your income with short-term rentals, so that way you have more time in your life and then you can spend more time with your family or doing as you please. Now, some investors want to focus on the appreciation and the tax play, and I'll give you an example of this. So let's say you have somebody that's working a high W-2 job. Maybe they love what they do for work. They don't see themselves stopping work for 15 or 20 years. That's great. That type of person can focus more on the appreciation and the tax play. See, we have clients that invest in high property tax states, high appreciating states like a California or a Florida. And what does that do? It's depreciation. Okay. We had a client in Destin, Florida, where they bought a property for $1.8 million in 2022. And over these last 3 years, that property actually lost $25,000 a year in cash flow. Why? Well, because property taxes, insurance, the maintenance expenses in Florida are a lot higher than in other places. He lost $25,000 a year for 3 years. However, this same property in 2025 is worth $3 million now. And he didn't do anything to the property. He put maybe $100,000 into it, right? But his appreciation over 3 years, it went up $1.2 million, but he lost $75,000, which, by the way, he was able to write that off on his taxes. So he lost $75,000 over 3 years, but the property is worth another $1 million. Right? So you're either investing in properties for the cash flow or you're investing in properties for tax benefits and appreciation. Now, you might be watching this and saying, what do I need to know? What are the roadblocks or the pitfalls that I need to watch out for if I'm doing this analysis? And the biggest thing I would tell you is that you want to make sure that you have positive and forward momentum. Okay? If you just sell a property and that money sits in a checking account and you don't have the vision lined up for what you're going to buy next, that is taking a step back, in my opinion. And so sometimes clients will have properties that have 13, 14, 15-year break even, and it looks to be a sell. But if you cannot tell me where you're going to redeploy that capital in and have a game plan and a roadmap for exactly how you're going to do that, do not sell the property because you would be losing momentum. You got to have that next deal lined up. By now, you understand the main difference between cash on cash return and return on equity. And you understand that you need to be doing this calculation at least once a year. By now, you understand that you are either investing for the cash flow or you're investing for the appreciation and the tax benefits. And by now, hopefully, you understand when you should hold on to a property and when you should sell a property. And if this was interesting to you, check out my podcast next week because I'm going to break down exactly how to exit your short-term rental property as tax efficiently as possible.